So franking credits and franked dividends. This is a concept that at first seems a little bit tricky, but it's actually very easy to understand. So let's say a business has made some profit and now they want to distribute their profit to the shareholders. Let's say you and me, we both own one share, and they want to give $100 per share of this profit to the shareholders. But before doing so, they need to pay taxes, right? So the business cannot just give you $100. They need to give you $100 minus tax, right? So let's say for this example, then the tax is 30%. So $100 is the dividend they want to pay. They give you 70 goes to your bank account, and then 30 stays with the ATO office in the form of a franking credit, which is basically a credit that can be used later on. So when the time comes for you to declare your income, you can say that you made $100, right, in dividends profit, even though you only got 70. So the other $30 are with the ATO office. So when the time comes to do the taxes, and then they look at that and then they say, okay, what's your income rate? And let's say your income rate is 30%, and let's say your income was only $100. So you already have the income rate of 30%. They gave, the ATO office has the $30 already from this 100, so you don't pay anything, but they don't give you anything either. So you're even. So you have the $70, it's basically tax free. So this is to avoid double taxation, right? So you're not taxed again at your income level or income tax rate for those $70 that you got in dividends. But let's say your tax percentage is lower than 30, let's say it's 20. So when the time comes, the government will give you $10, right? Because they kept 30 of your dollars, which is too much because your tax percentage is only 20. So they give you $10 back. And the same thing happens if you actually are above, or the opposite thing happens if you are above this 30%. So let's say your tax rate is 40, then you actually have to pay $10 extra, but you don't pay, let's say, 40% of the 70. You only pay $10 because you got $30 in franking credits. So it's basically, you need to imagine this as if like the company gave you the $100, but actually 30 you'll have to pay, or like actually it's as if the company gave you $100, right, of the pure profit. So, and then it depends on your income tax how much you're actually gonna get back or have to return. So that's basically the idea, and this is just to avoid double taxation. So this works in Australia and probably in some other countries, although there's some discussions that the Labour Party may want to change this, because if they give money back to people, so let's say you earn, sorry about that, let's say you earn less than $18,000, right, a year, you don't pay any taxes. So basically the company can literally just give you the $100 tax free. So Labour Party is not so happy about that, because in a way that income or that money is not being taxed at all. Yeah, so that's basically the idea. It's quite a simple concept to understand. I know the naming is a little bit trickier. And the franked dividend is basically a dividend that has franking credits. So it can be fully franked if it has 100%, right? So if all the dividend is franked, and then you can have other percentages, so on. But yeah, basically that's the idea. So you get a credit in the ATO office for the money that the company pays kind of on your behalf. Instead of giving you the $100 dividend, they just give you 70, and they keep 30 for informal franking credits. So that's one reason they say like it's nice to invest in dividend paying stocks, especially in Australia, because of that franking credit benefit, but also because Australian companies pay on average more in dividends, so the yield is slightly higher over here than it is in other countries, because Australia is like a small country, so there's not so much room for growth, and because of that companies need to somehow, you know, release the profits in one form or the other. So either growth, investing and growing the business, or paying the money back in the form of dividends. So the yield is quite high. In fact, Australia is one of the highest countries in the world in terms of dividend yield. So there's those two benefits: high yield for dividends in general, and then there is the franking credits. So those two pluses of investing in dividends in Australia. So I hope it was clear. If not, just leave a comment or watch some other videos. I've watched a few videos in order to understand this concept, because I've moved here recently and I wasn't familiar with the franking credits, and some examples like really complicate a little bit too much what's franking credit, but at the end of the day it's just a credit the ATO office keeps, and then when the time comes, then they compare your actual income tax rate with the credits that they have, and they either give you money back or you have to pay on top of that 30%, so you're not double taxed on the dividends. So yeah, let me know if you have any questions. If not, I'll see you on the next one.